I would just see like one offer after another offer, very tempting sometimes, right? But the fact that I'm in the industry, I know to stay away from these offers that are sent out my way. And so I thought we should talk about it because how many people are actually getting themselves in trouble because of the gamification way of doing things when it comes to the financial services company. Welcome, everyone, to the Money Mindset Mastery Show. I'm your host, Jim. Joining me is my co-host, Ryan, and our other co-host, Eric. Ryan, how are you doing?
It's great to be back into technology world after the last hiccup of our last recording. And even this one was a little bit frantic to get onto, but technology has come back and it won't be going and breaking my heart today. So.
Yeah, and Eric's hiding in behind of his car right now.
Yeah, sitting in the back of the camper van in a parking lot in Vancouver. There's worse places I could be, like freezing cold Edmonton.
That's true. So what's the weather like out that way?
It's probably about 18 degrees. I'm wearing shorts, so that's good.
Nice. And you're doing or Snoopy's doing what I wish I was doing right about now.
Yeah. I don't want to do it today. I'll do it tomorrow.
Well, today we're talking about gamification in the financial services world. So the episode title is When Finance Feels Like a Game, How Gamification Can Push Canadians into the Wrong Products. This kind of came up because I've noticed, I mean, it's been going on for a while, obviously, but recently as I've been going into my own apps from some of the platforms that I use and I'm connected with, I would just see like one offer after another offer, very tempting sometimes, right? But the fact that I'm in the industry, I know to stay away from some of these tempting offers that are sent out my way. And so I thought we should talk about it because the immediate thought that I had was how many people are actually getting themselves in trouble because of the gamification way of doing things when it comes to the financial services company. And Ryan, it seems like you're dying to say something, so I'll give it to you.
No, it's just, it's come a long way since giving away free toasters and blenders, right?
Yeah.
And gamification for a younger generation is creating a world, especially when it comes to the behavioral side of things. It's just creating a behavior that, I don't think a lot of us really realize the impact it's going to have. Although I see it with our coaching clients quite often of how easy things can be to get trapped into this kind of world of getting into more debt and getting these little twinkling things that distract us from what's really going on. Lots of studies show already that, the amount of debt that we're already taking on is partially created by some of these things, right? That we didn't realize before. Anyway.
Yeah. And so much so that here in Ontario, the Ontario Securities Commission has kind of taken attention to this because I think they're starting to recognize it's a bit of a problem. And, to your point, gamification really isn't new. It's something that's been around for many years, just in a different format, right? I still remember one of the last banks that I worked at over 25 years ago had, we were giving away toasters. If you opened up an account and with X amount, I think $5,000 deposit and held it for 90 days, you got a free Black & Decker toaster, right? And I remember iPod giveaways as well and whatever else. But it reminds me too, when I was a little kid, growing up in an Italian household, we didn't really eat out often. It was very rare. But the times that I would really be a pain in my mom's behind was when McDonald's had their Monopoly game board, right? And I had to go to McDonald's. I mean, I like the Big Macs, but it was because I wanted to get that sticker and fill out my Monopoly board, right? And that's what drove us to McDonald's. My mom really, didn't want to go, but it was something that we did. And then as we get older, there's different forms of gamification. Eric, do you want to chime in on this?
Yeah, I like the McDonald's story because that has a really interesting aspect that a lot of people didn't realize and still don't realize. And that was what they would give you almost all of the game pieces quite easily. And then there were like one or two or three that were the really hard ones to get. And so it's interesting that they've tapped into the difference, I think, between then and now is that we really do understand how our brains work. They've tapped into the psychology of gamification, and it's
Yeah.
great if it gets you to start saving and you weren't saving before. but it's
Right.
not great if it gets you to start investing in something that isn't suitable or making decisions like getting a loan. So yeah, no, I really do think that this is a timely episode because more and more this understanding of how to really game the human mind is
Yeah.
becoming almost a commodity now, where it used to be very, very select. I mean, RBC still, I saw them offering an iPad, like, so they're still
Well,
doing it. It's just not a toaster anymore. The new appliance is the new
it's an Apple
appliance.
Watch actually now.
Now it's
So
an
that,
Apple Watch.
but at the same time, we have to understand that we're being played, and I think that's the biggest walkaway that I would like people to have from this podcast is how to know when they're being played and how to know when it's a good thing. Because honestly, there is a lot of gamification that has gone to helping people be more responsible, to budget better, to make better
Yeah.
overall decisions, to learn languages. But when is that then being used to manipulate us for their end at the expense of our end? And I think that's the key people need to learn to watch out for.
Yeah, or even be careful about free offers or free deals. I'll use Credit Karma as an example. Once upon a time, clients would ask me about checking their credit rating and whatever else, and say, "Hey, go to Credit Karma because you get to once a month you get a free credit report." But so I signed up for an account for myself for the same reason. But man, every I keep getting credit card offers from Credit Karma, right? And then I'm thinking again, I mean, I know what they're doing and I can protect myself and resist the temptation of applying for those credit cards. But what about the people that can't, right? And that's what they're doing. And I don't know how many emails I get from them specifically in a month. Like if I haven't logged in a few months, I'll get an email at least once a week. Hey, it's been a while since you've checked in. Like log in, check your report, right?
Making you
And then
feel bad you haven't logged in already.
that's exactly it, right? And well, because it's kind of triggering that curiosity of, does that mean there's an issue with my credit, right?
Did I miss?
Exactly. And then the following week, I'd get another one. It's like, hey, you know what? You haven't checked your credit rating, and you should check because there could be a problem or whatever. Like they start to scare you a little bit, and eventually it's just like, okay, enough's enough. I'm just going to check to make sure everything's fine, and of course everything's fine. And then, hey, apply for this credit card, and you can qualify probably for a $10,000 limit, right? So that's how they draw people in. And again, for people who understand that and are able to resist, not an issue. I'm more concerned about the people that fall into those traps and get themselves into bigger trouble. I'll use an example when John and I first partnered up back in 2008, John being the mortgage broker. We would sit down with clients who were in financial trouble. John would work through a full refinance plan for them, clear up all the credit card debt, because usually that's where people would get themselves in trouble, was the credit cards. Clear up all their debt, improve their cash flow by $1,500 to $2,000 a month by clearing all that consumer debt. And the issue was that in order for them to complete the mortgage, they had to go into a branch to sign the documents. So I'd put a plan in place. We'd put, a savings plan of $1,000, $1,200 a month. And we feel like we've done a great job for these clients. 3 years later, they're calling us saying, hey, we're in big trouble financially again. We need your help. We've got all this consumer debt. And we're like, what are you talking about? Like we cleared all that up 3 years ago. What happened? Well, when I went to the branch to sign the mortgage acceptance, they pre-approved me for a $25,000 line of credit or credit card. So we accepted it, even though we canceled them all to qualify for the financing. And they would just get themselves back in trouble again. So it's too tempting, and that's what we're trying to avoid right now.
Being on the behavioral cash flow side of things, there's this, it's the ease, it's the frictionless process that goes along with making it very easy for people. Unlock more rewards, you're pre-approved, all these like easy sayings. But when you have a great team around you, you don't necessarily have to worry about things because we're helping a lot of clients create the new behaviors to make sure that they're not going back into more debt. We go through this quite often with the cash flow side of things, and man, the amount of times that I've heard exactly that same story that you just said of clients going into the banks not truly having themselves as the best interest, but simply meeting a credit card quota that they have to make, and suddenly we're unraveling the work that we've been working so hard to do. That's why we made a decision not to simply do a cash flow plan that didn't involve an educational piece or a habit creating piece, but we wanted to create something that people had a coach along their side for
Mm-hmm.
6 months to a year, because it was really starting to create better habits for that person, that they weren't going to get stuck into these things. So that's why I take that deep breath, those woo-saw moments, to make sure that, that people aren't recreating the same problem that they had before. And, this is not necessarily gamification, but it sometimes talks about the gamification, about how easy it is for a lot of clients to just move from their current mortgage to the next one without any real, hey, let's talk about where you're at right now before we make the next move. And that's what I really appreciate with John and working alongside us, is we have a game plan. We've talked it through. John understands what the pieces of the puzzle are of how we're going to consult, not just to consolidate debt, just to consolidate, but we're going to create new behaviors behind that.
Yeah.
And with a lot of people right now, with the largest number of mortgages coming up for renewal over the last year, going into the next year and a half,
Yeah.
that's always great for business when it comes to cash flow and trying to create new behaviors, people. But I'd rather not be in that business of trying to financially educate so many people about what's going to continue to repeat itself over and over. And if they don't think it's going to happen generationally, we learn our habits from our parents. And when your kids, who are 1-2 years of age, 17 years of age, see that repeated program happening, it's instilled in them. So I think it's important to think about how gamification, how the frictionless transaction can really have an impact generationally for people, and not just for yourself right now.
Yeah. I'm going to go through some examples. I'm actually going to log into a couple of my apps that I use, and just to see, hey, what offers, because I'll guarantee you with some of them there's going to be an offer or two there. But there's a recent example that just came up, and Ryan, kind of going back to your conversation about helping clients and planning, and a bit of a conflict that I've kind of see right now. So I'm personally going through a mortgage refinance renewal, okay? And it's going to go from one bank to the next. That I received a phone call 2 nights ago from that new bank, and it was someone who's from I'll name the bank, Scotia Financial Planning Department, which is funny that they're calling me because they want to talk to me about financial planning.
Maybe they need your help.
I don't think that's why they're calling. I have a feeling, and I don't know this for sure, so I'm not going to sit here and say that I'm 100% certain that this is what happened, but I have a feeling that my file was opened up with Scotiabank, because that's where the mortgage is going to be going to, and they gave my file to one of their financial planning people, right? And in the message, it was, we want to talk to you about helping you with your financial planning. We help with debt management and all those things. And I thought to myself, I kind of sat, I'm not going to call them back, but I thought to myself, as a client, if I were to make that phone call and speak to the Scotiabank financial planner, there's a bit of a conflict, because, yeah, they're going to help me with my debt management today, but it's the same bank that's going to send me a Visa offer at some point. It's the same bank that's going to send me a line of credit offer at some point. And what could potentially happen? Get myself back into that hole, and then they're going to send me back to the financial planning person to help me clean up the trouble that I got myself in. And then in the back end, they're going to send me another offer, right? Another Visa offer, line of credit offer. And it's just this vicious cycle, right? So I do feel there's a bit of a conflict there, that if you're going to offer financial planning services, that you shouldn't be able to offer some of these other products that could potentially get you in trouble. And not to say that people shouldn't have debt or credit cards or whatever else. That's not what we're saying. Like, if used responsibly, there actually are very effective and good tools to have. But I just don't know what level of support someone would have when, again, they're dealing with an institution that's fixing the problem in the front end, but then also causing the problem in the back end. Right? I don't know, Eric, do you have any opinion on that?
Yeah, that's a really good key point that we want to bring up, that brings more validity than just three dudes talking about a gamification. This
Yeah.
is why tied selling laws exist. The
Yeah.
banks are not allowed to intershare detailed information, or are not supposed to intershare information that allow them to use this information to really be predatory in that sense. It doesn't
Right.
stop them from still using tactics that could be considered predatory. But I
Yeah.
think that's the important thing to know, is that, like, that's why they've created laws. The laws don't catch it all, unfortunately,
Yeah.
and probably never will. But it is a legitimate concern that every person, when they're looking at a piece of marketing, they should always be asking themselves that, okay, how am I being played here? Is
Yeah.
this really to my benefit or to the bank's benefit? And it's
Yeah.
a great time to bring AI into it. There's often times where I think, okay, I'm looking at a complex issue. I could probably do a
Yeah.
whole bunch of research to try to figure this out, but I'll put it to them. Say, like, I'm considering A and B.
Mhm.
What would be the smartest? What would be the dumbest? Why would
Yeah.
both of them be good? Why would both be bad? And it
Yeah.
brings a level of objectivity to the table. And again, especially when you're looking at fees, they
Yeah.
really like to make things complex in a
Yeah.
lot of these financial instruments. And if they're so complex that even you and I and Ryan have to bend our minds to really understand these things, well, a layperson can say, okay, well, what's the difference in fees? It's just important for people to always be on the alert to say, okay, if I'm being influenced,
Yep.
how is this going to be a benefit or how could this be a detriment?
Yep. Now, earlier today, I logged into, I bank with CIBC and I bank with Scotiabank. So those are the two banks I'm going to be naming today because I personally bank with them. I did log into my CIBC app earlier today. I was surprised. No offers, nothing to kind of suck me into anything, nothing whatsoever. Scotiabank, I logged in. Now, it is reminding me that tonight is the RSP deadline. For those of you who are looking to make an RSP contribution, if you like, give us a call. We can also help you as well in making that contribution for midnight. But they did send me a reminder here about the deadline being today, midnight. But I do remember 2.5 weeks ago when I'd log into my Scotiabank app every single time, right at the top of the app, there was my 17,500 RSP catch-up loan offer. Basically, hey, you've been approved for a 17,500 RSP catch-up loan. Click here for you to open up the account. So once again, a lot of people are thinking RSPs right now. There might be some people who are sitting there thinking, I would love to make an RSP contribution. I just don't have the money in the account because I'm barely scraping by. Hey, maybe I'll do this RSP loan thing without really fully understanding what that really means for them from a financial point of view. Not understanding what the cash flow situation might be. Of course, it's going to have to go into a Scotiabank investment. I know a lot of people who've kind of self-accepted some of these offers. They're putting them into GICs in an RSP, so they're actually paying more for the RSP loan that they're getting in return on the investment because they don't know, right? They're like, well, I don't want to take a risk. It's a loan, so I'm just going to get this GIC thingy here and, get the 1.5%, 2% while they're paying 5 or 6 on the RSP loan. So that's one way that people can get themselves in trouble.
I logged into my two apps while you're chatting. Sorry, Jim.
Okay.
So one
Good.
offered my increase for my credit card,
Okay.
which I just declined, and the next one also just offered me an increase in my bank. So no one's offered me an RSP because I'm very selective as to how I have a strategy for my own RSP distribution. So that's very funny that two of the banks that I use for different things have both offered me a increase.
There you
Maybe
go.
they know that I want to go on vacation or something. I don't know. So
Maybe. Big Brother heard you.
yeah.
Eric, do you bank with traditional banks or do you kind of do some funky stuff? Not illegal funky
Yeah,
stuff, but not
yeah.
tradition. Not tradition.
Yeah, I have banked with the big Canadian banks in the past, but right now I do use Alberta Treasury branches, ATB. I like them because they don't have the big corporate backing, so when you log in, there's no offers. Their web interface is maybe a little too simple at times, but that too simple means that they're also not churning their data pool for how they can try to take advantage. It's
Yeah,
also quasi-government. It probably has some measures that kind of restrict that. But I also use Tangerine.
right,
Tangerine is notorious. Every time I log in, I have to X out the little thing at the top because it makes it so I can't see everything else without scrolling. But it's
right.
the credit card, or we have a new high interest account, but you have to move $50,000 over. And then I also use Wise. I do like Wise because it's just purely transaction based. So they don't
Right.
have credit cards. They don't have any of that stuff to offer.
And on that note, profit. That's the driver behind all this, right? It's all about profitability, getting more money, getting more clients to buy into these programs, to kind of put a fence around them as well. I remember when I worked at one of the big banks, I forgot, I think it was the Premier account or something to that effect, which if you as a client had 3 or more banking products with that bank, you received this special black debit card. It didn't give you any more power or anything, but you felt special because now you have the Premier account. And I remember when I was in the meetings, when they talked about launching the Premier account, it was based on data that the bank had put together that if a client had more than 3 products with a single bank, Basically there was like a 20% chance that they would leave the bank, not because they liked the bank, but it was just a to leave them because of all the products that they have to switch over, right? So that's what they did. They created this premier bank account concept, and people were like, "Ooh, I'm premier," and it's like, yeah, it's because you have three or more products, and they're trying to keep you locked in, right? And then you spoke about Tangerine. Before Tangerine, it was ING. Their bread and butter was just because they offered the best savings rate in the country. That's it. There was nothing beyond that. It was just they had the best rate. Usually it was like between them and Manulife Bank, back and forth. And then Scotiabank bought Tangerine or ING, and that's when the gamification started, right? It was from all the Scotiabank experience, right? I remember when I was at Scotiabank and they launched a product, and it was strictly launched from a marketing point of view as a mutual fund. It was a horrible idea. And what we had found out as the advisors trying to raise money for this mutual fund was, from an investment point of view, was horrible. They didn't really speak to any of the mutual fund managers about the concept. It was just all about marketing, right? And then they had this other platform, which was the best of the best mutual funds. They packaged it up into like a pool. And I remember sitting in a meeting with the designers, and I said, well, it's the best of the best. Like, what determines it to be the best of the best? Well, we look at the last 12-month return, and we pick the 10 top performing mutual funds in those categories, and then we package them up for the following year. And I'm like, okay, and then what happens in the following year? Well, the poorer performers, we get rid of those, and we replace them again with the best performers 12 months prior to that. So basically, I look at them, I'm like, so what you're saying is you're selling you're selling low and you're buying high. And they're like, what do you mean? And again, I'm talking to marketing and product designers, right? And I'm like, you're literally doing the opposite of what people should be doing in terms of making money when they invest, right? And I think that program lasted like 5 years because it was just like the worst product ever designed, right?
Yeah, interesting that you bring that up. There was a study that you've heard of, the monkey study, where they had monkeys pick stocks and they did as good
No.
as, I think it was done in the
Yeah.
60s.
Are
And
they
they
those
wanted,
down on Bay Street?
yeah,
I think I
yeah.
saw them on Bay Street wearing ties.
That's probably. Well, they did this back, I think it was in the late 70s, and they averaged 100 monkeys, averaged as good as 100 random stock pickers at the time.
Really?
And so about 10 years ago, they wanted to recreate that to see if there was any fundamental structural problems in the study, to see if it
Okay.
actually had some validity. And they did, they repeated it. And one of the things that they found was like 86 or 87% of funds that did well in the previous year did
Uh,
horrible the following
yeah.
year.
Yeah.
And I mean, like 86, like that's, you could almost do a better job at picking what are the worst 10 funds this year and put that in a
Yeah.
fund, and you probably would have outperformed that one that was picking the best.
Right. Well, I never heard
Yeah.
that, so you guys send it to me.
Yeah, I'll have to
I,
dig
le-
that up again.
I remember that study in high school because I remember my teacher, Mr. Baraka, told us about that study because he introduced us to stocks. And at the time, I want to say it was TD. TD was offering this like underlying, they would give you a fake $10,000 and you'd break up into groups, and each
Yeah.
group would have and see who ended up doing the best, and we had to compare ourselves to the monkeys. And of course, I think three of the 10 groups in our class outperformed the monkeys, which meant thankfully I was in the top half.
And
So
that's why
I
you're an
wanna know
advisor
what
at
you're
TVH.
doing.
yeah, no longer advisor at another institution. Here's two random things. One of my other things I finally logged into, and I've never seen this before. And it's funny because obviously it's listening to me, because I've talked about potentially getting my son some sort of credit card to teach him the idea of understanding credit debit, because the bank at the time won't give us a debit card at 11 years old. So I thought about, what if I made him a potential user for emergencies? And funny enough, they just notified, this account allows you for multiple users. Is there anybody in your home that would like to be added to your current thing? Followed by the increase of my minimum. So the other thing I was going to say, because I was very intrigued, and I know I had started digging deep into understanding the numbers of what is the true cost of the free iPad, the Apple Watch, the television, the blender, whatever, wherever you are. So here's a breakdown. So starting a new checking account to get that free iPad or Apple Watch. iPad nowadays costs you $500-600.
Mm.
Apple Watch probably around the same the checking account that people sign up for, basic monthly range that they're potentially going to be charged, depending on if they keep their balances, $25 to $35 a month. So annual cost $300 to $420 over the course of a 2-year period, because that's usually the terms if you receive the watch or the thing that you have to keep the item for at least 2 years.
Okay.
So that's $600 to $840 in fees that you've paid. So you've already paid for your watch.
Right.
Here's some other things to consider. Likely has a minimum balance. So most usually sit to want to have $2,000, maybe perhaps $5,000 minimum balance in that. If you're not, every year you're charged. That is a 4.5% potential. So it could accumulate to around $225. Now we're at $450 for 2 years. If you exit out early, you will forfeit any of the remaining promotions, plus you will owe back money for the remaining balances left on your iPad, Apple Watch,
Right.
whatever it is. So whatever that calculates to.
Yeah.
So
you're stuck.
So you're stuck for 2 years with an Apple Watch or iPad that cost you more in the end to have it, to sign up for it, because of all these other little restrictions. And it's the fine print that we often talk to people about and make sure they understand. It's like mortgage insurance. Have you read
Right.
the fine print of what my mortgage insurance is, right? So, and again, the psychology of it comes in is people are they just want this flashy item, but don't realize all the things that come, the strings that are attached to it. People are fatigued, and the industry knows that. The people are fatigued when it comes to decision making. So the easier that we can make things, again, this is the psychology and behavior side of it, is the more fatigued we are, the less decisions we truly want to make, which again cycles back to the gamification of just let's make it easy for people, right?
Yeah.
And without them realizing the true cost that it ends up costing them when it comes to signing up for a lot of these things.
Yeah, and the promotions and stuff, I don't have a problem necessarily with the promotions. It's a way of building your business, attracting clients, whatever. I mean, the bank's going to use it as what do you call it? A loss leader in many cases, because once the person opens up that bank account, then they're going to start hammering them for the mortgage and the credit. That's where they make their money, right? Is the mortgage, the lines of credits, the mutual funds, and whatever else. So from a business point of view, like I understand that strategy. I think it's, to your point, Ryan, is as long as people understand what it all really means, right? And that's all we're doing here. We're not saying, gamification is evil and don't do it. We're just saying be careful, right? Because we're bombarded with it's everywhere. It's not just in the financial services, it's everywhere, right? So just be aware and be mindful of what those offers are and to control yourself, right? I just logged into one of my trading apps. I'm not going to name the names, but people probably would guess what it is. But so the first thing I look at is register for an Unreal deal. Fund your first $1,000 and we'll send you a keychain in your favorite color. And there
Rather
are
a
people,
toaster.
you're right, but there are people who would sit there and say, I'm going to open up an investment account for $1,000 just so I can get that keychain. Is that financial planning? Is that going to benefit you in the future in any way? Do you understand? Is that going to do anything for your retirement or whatever those goals are? No. But people are literally, there's 4 colorful keychains in the ad right now in the app. And there are people who would look at that like goldfish, right? Or like a fish in the lure saying, I like that. I'm going to register now and click that button. Like that's how easy it is, right? So if I scroll down, and of course I can see like all the different accounts that they have available, nothing wrong with that. I love this one. Get a 3% match and win a $3 million home. So get up to 3% back on account transfers and 5,000 entries in the giveaway. Terms and conditions apply. So Eric, if you went out to your client and said, give me $100,000 and I'm going to give you 3% back, and I'm going to also enter you because you could potentially win a home, what would the regulators do about that or say about that? Would you still be licensed today if you did that?
Yeah, I can't see that going well in any sense of the. And the interesting thing too is, Jim, the volume of clients I would have to process to be able to even come close to making that, like a realistic thing. I would not, like, the service level would have to be so extremely low. But yeah, no, from a regulatory standpoint, like 100%, I couldn't even get that past our compliance team, let alone the
No.
regulators.
Well, first of
Yeah.
all, that'd be considered rebating. We can't rebate, right? Now, terms and conditions apply. I'm not clicking the register button because I don't want to find out. I don't know if there's a minimum, a maximum that they would do it. But hey, I can also win a home if I do this, right? And I get 3% back. Ryan, if you recommended a portfolio and said, I'm going to give you 3% back on whatever you transfer over to me, and again, I'll enter you into potentially winning a home, how do you think the regulators would handle that situation?
Yeah, I'd be called into somebody's office and they would go through all my files to make sure I wasn't doing anything fishy and asking what the heck is going on. So, yeah,
Well, I
there's a
think even if you gift a client with, I think it's $50 or $75. I don't know the number offhand. You have to somehow disclose that, or you're not allowed to a certain threshold. Or even if we get invited, like I know Eric on the private side specifically, if a sponsor gives you a gift that's above a certain threshold, you have to disclose that, don't you?
Yeah, yeah. I mean, it's like $100 too. So it's like any amount. If they even take us for dinner,
Yeah,
that's likely going to qualify and has to be disclosed.
has
yeah,
to be McDonald's only. So,
right.
Yeah. Yeah,
So
yeah,
in
yeah.
this case, so in this case here, if you did 100,000, and again, I don't know the actual terms. I'm not going to click on it to see if there's a max or a minimum. But let's assume it's 100,000. You move over 100,000, you're getting $3,000 back. Now maybe the 3,000 is discounted against a management fee. Maybe they credit that into your account. Like I don't know how they do it, but all I know is people are not going to sit there and say, oh, this is how they're going to do it. I don't like that. They're going to be like, I get 3% back and I can win a house. Click. That's what they're
Yeah.
looking at, right?
Well, and the other thing, Jim, that I want to point out there too, this is another great use case for AI. Copy and paste the terms and conditions and say,
Yeah,
what's wrong with this?
yeah,
And because I mean, whoever reads the terms and conditions? And like
yeah,
9 times out of 10, I'm like, that's in the terms and like I'm not going to participate in that. And it's quite startling what they get from you just from a data standpoint, let alone the other cross-selling and all the other stuff that can
yeah,
happen.
yeah.
and nighttime reading, I've been reading the terms and conditions for a lot of things. So that's why I still have my firstborn, is because I haven't been willing to hand them off to anybody.
So here's another thing. I click a gold coin now on the app, and that gives me a whole bunch of entries into winning one of 15 gold coins, right?
Gee.
So literally, I don't have to buy it. I just have the app open, and literally there's a gold coin floating. I select that, and I
Hey,
automatically get
Super
entered.
Mario.
Yeah,
It's Mario.
there you
Get
go.
you collect your gold coins. Look at
Yeah.
that.
So now let me just see here. Go ahead.
I was going to say, and it's important to note that trick is solely just to get you to log into the app every day, which may
Yes.
not be a bad thing, but at the same time, people who aren't going to be a day trader, because day traders are their own kind. But if you're not a day trader and you're checking your balance every day, you're going to have 50% of your days are going to be bad. So that again, that's the problem. Like if you're not going in and trying to trade on a regular basis and you're not trying to be really thoughtful about that and really technical and strategic, then watching that balance and that fluctuation isn't necessarily a good thing. So to go in and get your gold coin, 100%, I say do that because it's easy, it's low friction. But
Uh,
try not to look at your balance if it really upsets you emotionally, because that's where the bad decisions start to get made.
Well, perfect segue because now I'm into the non-registered account in my trading account. And about 2 weeks ago, every time I would log in, hey, you qualify for a $2,000 margin account. Just click here, enable margin. Well, as of today, my margin account is now, I can qualify up to about $5,200, right? So
Gee.
2 weeks ago was about 2,000. I'm already at 5,200 if I decide to enable margin. I haven't, right? And for those of you who don't know what that is, margin is you've borrowed to invest. It's leveraging. Eric, what level of documentation and disclosure do you have to provide compliance when someone says, I'm borrowing money to invest in one of these private deals?
But yeah, whenever leverage or borrowing is involved, the process of me providing proper suitability doubles.
Right.
Every little decision has to be taken into account. I have to make sure I explain to the client that leveraging can give you an enhanced return, but it can also create an exponential loss.
Yeah.
And so yeah, it can double your returns, but it can quadruple your losses. And that's what a lot of people don't understand. And when they call it a margin, well, what is that? That sounds harmless. Push a button. Hey, I'm doing it. Well, all of a sudden, a month later, you can be underwater. And I have had clients come to me where their past advisor had them borrow the entire equity from their home. And I mean, if markets were doing great, that would have been fine. But this was in 2008. And all of a sudden, their investments were worth half of what they had initially put in. And so
Yeah.
they had lost like half of their mortgage now was due after they'd paid it off just
Yeah.
because a couple months on a margin call. And so yeah,
Yeah.
it's a very technical, like someone who plays with a margin account, you really have to understand what you're doing. Because again, like I say, in my world, it doubles the amount of work I have to do to make sure a trade is suitable the minute we add that technicality of borrowing to invest.
And I think that's the point that we're trying to make here right now is that for someone who's not working with an advisor and was strictly using these platforms, like right now, I can click enable margin, probably have to sign a few documents. I'd be able to add another $5,200, probably buy a stock or two. Potentially that gets wiped out in a couple of days, like I lose half or all of it, right? Or I could double it, right? But that's gambling. Where when you're working with an advisor, I had a client literally last week who said to me, I just freed up 50,000 from my line of credit on my home. Should I invest that money? I know her situation. She's widowed. She's about 7 years away from retirement. And the first thing I said to her was, well, it is risky when you use leveraging. We don't say no to leveraging. Like we do use that strategy as well. But I made it clear to her that when we look at leveraging, it's a 10-year minimum hold, right? It's not a quick kind of make money within a matter of months. And I'd ask her the question, do you think you might need access to that line of credit over the next 10 years? And she's like, probably next year, actually. And I'm like, then no, we're not leveraging any of that money because it's too risky. But if she didn't have us as advisors and she had this app that I'm holding in my hand right now, she could have clicked it. It's like, hey, yeah, I see it could be risky, but look at the markets, look at the stocks are going up. And again, it's casino gambling for a lot of people, right? And could get in a lot of trouble. And the funny thing is, as I'm looking at this app, right below my margin offer, what pops up again? Get up to 3% match with a $3 million home. So again, it's like, I'll click the margin. I'm going to open up another account, transfer a bunch of money in there, get that 3%. Man, it's a win-win-win. I can't lose. And this is where people get themselves in a lot of trouble. People who are not sophisticated, who don't understand how money works. Ryan, I think you're kind of like shaking a little bit with all this stuff going on.
Yeah, I saw what my margin offer was too, and I was like, that's an awful lot of money. But I think when it comes down to it, we talk a lot about really working with a client to understand what their risk tolerance is, what their game plan is, short term and long term, and taking those all into consideration. And the gamification, the touch points don't take that into consideration. And clearly, now that the regulators are finally stepping up, because I've been questioning the processes of what I have to go through, the hoops I go through to get approval for things versus the approvals of some institutions and how limited they are. And now finally the regulators are stepping up their game. Hopefully, there's a couple listening out there. Hopefully they step up the game to have a little bit more explanation. As Eric said too, like there are situations that this can be a great starting point for some people. There are ones that say, hey, start up a monthly withdrawal to make sure that you're putting away X amount of dollars per month. That's a great start. All day long, let's make sure that it fits within your budget or your plan or your cash flow to make sure that that is proper for you. But there's very few of these offers that I've seen, especially since we talked about wanting to do this episode, but really over the last year of us being more and more aware of what's out there, to use extreme caution, to just understand that what is it going to cost you in the end? And I think, Eric, you had mentioned it too, is like, what are the things that are nudging you along the way? These fun streaks and badges that you get. And it's not like a fitness app that you're just trying to make sure that you get your steps in or something like that. That's a little different. But as you walk through, like, what is it worth and what is it costing you in the end? And we often, when working with a client, ask the question, what's preventing you from sleeping at night, right? And by clicking that margin, not understanding the full realm of what that means, having the education behind it for you, Jim, to ask the right questions. What are the plans with this money? Man, oh man, the clients that will be under great stress over the next little bit because they pressed a button that they didn't realize could cause a lot of financial harm. And that financial wellness trickles down to your mental health, which then trickles down to your psychological health and all the health
Yep.
of every other wellness slice of piece of the pie. So I just want to make sure that people ask the question and that they're getting the right information from hopefully an advisor or an institution that actually cares about their well-being from start to finish, so as we do. So
Yeah, we might not be as exciting as the gamifications, but we'll definitely help support you and guide you in not making some really bad financial decisions to protect yourself. Boring
speaking of
sometimes,
that, speaking of that, what's our next offer, Jim?
yeah.
Limited time only.
Yeah, I,
So
I do
I'm
have
gonna.
a
Oh, go ahead.
yeah, I do have an elderly lady who calls me every once in a while. She's like, "I'm so sorry to bother you, Eric, but I just didn't understand this." And it's really all kinds of things. Like her husband has passed away probably about 4 or 5 years ago now, and she was buying a vehicle. And again, I think vehicle financing people can be some of the most challenging for weeding through potential conflicts of interest. But she had this financing offer, and she was like, but someone else is telling me I should be leasing, and I'm like, this is perfect. I'm like, this is exactly what I'm here for.
Right.
I can help you weed through this really quickly. Let's talk about the terms. Let's talk about all of this. I can do a quick analysis. And really, in 5 minutes, I was able to help her to understand that what she was being proposed actually was the best scenario. And her friend who was saying she should lease, just a few quick questions, and I can help to understand that. And I think that's what I want people to not be afraid to do. Like, you have a question, it doesn't matter how mundane it is. A lot of this stuff we understand really deeply. And an hour or two of you as a as someone who's a layperson trying to wrap your head around something and then maybe making a decision that you pay for a few years, give us a call. Like,
Yeah.
a lot of this stuff, like I said, is easy. And if it's not, well, give us 10 minutes. We can go and do some bigger number crunching and get back to you. But that's what I've always told my clients. I'm like, if you have a financial question in any regard, I don't care what it is. I don't even have to get paid on anything. If I can make your life easier, then that's part of what I want to be able to provide to my clients. So yeah, call. You have a question. We don't care how small it is. The smaller it is, the easier we can answer it for you, and hopefully the better we can steer you in the right direction.
That's why in our title there's advisors, right? We give advice. That's what we do. But these platforms don't, right? These platforms are all about click here and get more of this and more of that. It's exciting, and again, it's like going to the casino, right? There's a reason why people go. There's an excitement behind it. They like winning, and a lot of times you go in, you start the evening, and you win just a little bit. Kind of gives you hope, right? It's because they want you to put in more money in those machines or doing whatever. Kind of like golf, the same way. My golf game's that way. Starts off good, halfway through it's horrible. I'm on the 18th. I'm ready to give up, and all of a sudden, I finish off great. I'm thinking, oh, I can do this again. I'll come back the next time, right? So here's some top 10 questions you should ask yourself before you click a button and accept the offers. All right. The first one is, what action is the app trying to get me to take? Is it trying to get me to trade more, spend more, upgrade, or borrow? Again, nothing wrong, right? But ask yourself, what is it trying to get me to do? Okay. Question number 2, would I still do this without the reward, badge, or limited time offer? That's a very important one. Would you have moved your $100,000 over to that platform if they weren't going to give you 3% back and they weren't going to enter you into a chance to win a $3 million home? That's, I think, a very important question, right? Number 3, what's the worst case outcome if markets move against me? If you got a margin call and all of a sudden markets go in the opposite direction, what is the worst case scenario? Or what if you had that $100,000 in your current portfolio invested a certain way and you moved it to get that 3%, but maybe you didn't invest it in the right risk profile portfolio? What's the impact there, right? Is this reward fixed, or is it variable or lottery-like? Some of the ones that I think I went through today, there was definitely some lottery feels to it, right, in terms of clicking here and potentially win something.
But winning
What's my
the house is
yeah,
the perfect example of that because like one person will win it, but out of how many? And that's
exactly.
extremely lottery like. And if that's what pushes you to make that decision, well, yeah, interesting way to look at it.
Yeah. Next one, what's my cooling off rule? 24 hours before acting. I mean, I have that rule in spending because I'm a bit of a spender. But I think people should also enact the same thing when it comes to these offers, right? Give yourself a 24-hour cooling off period. But here's the problem. Some of them are like act now or you're going to miss out, right? It's that FOMO. That's what they do, right? So people want to act on it right away. But here's one. Can I turn off push notifications easily? I have not found one where you can, right? It's either a push notification or once you log in the app, it's like right there in front of you, right? So you could probably turn off the push notification, but once you log in, they're bombarding you with the offers. Am I paying interest? And if yes, points likely lose. So are you paying any interest on? So the margin offer, for example, for people who don't understand, they might think, wow, I'm getting $5,200 for free. This is awesome. Well, there might be a interest rate attached to that. You should find out what those are. And is it kind of in line with the industry, or are you paying more just because it was just too easy to accept, right? So do a little bit of research. What fees apply? I know, Ryan, this is one that you kind of like, looking at kind of the fees and the fine print and whatever else, right? But that's a very important question to ask. Does this create concentration risk, putting in a single stock, a sector, or crypto? I know there's a lot of crypto offers out there. People, again, are dealing with a bit of FOMO, although with the way crypto has gone the last couple of weeks, I don't think people are really too interested in getting in at this point, right? But crypto was definitely a big one. Marijuana stocks, when they came out, that seemed to have been a big one, where there was a lot of these offers as well. And then finally, how does this fit with my plan? I think that's really the most important question, right? Is how does this fit with your plan? Moving that $100,000 out of a structured portfolio that might be suitable for you into something that is giving you this 3% back and potentially putting an entrance into winning a home. How does that impact your overall financial plan? All right, those are some of the questions that you should be asking. So I think that's it for today, guys. Anything else you want to add, Ryan or Eric, before we shut her down?
Eric, you're the more relaxed one. I want to hear from you first.
Yeah, no, I think
What's
we kind
Snoopy
of hit
say?
all. Yeah, yeah. Snoopy says maybe tomorrow. But no, I think that yeah, 24 hours. Yeah, actually, that's I'm going to use that as the shirt motto now.
Do as
Um,
Snoopy does.
and do as Snoopy does. But yeah, no, I don't think I have much more to add. I think that that's the key is think through everything. Ask yourself, is this something that I need, or is this something I'm doing because of the benefit? And put it to AI if you're really considering something, because it can dig into details and wrap its head around way more than most people are going to be able to in a very short amount of time. And then also, don't be afraid to pick up the phone. Like that's what we're here for, is to help you sift through all of the possibilities to really build your financial plan. And we have a very objective look at things. Like a lot of people, they take those credit card offers because they're under a little bit of duress. Maybe they're not sure how they're going to make ends meet, or the contract billing that they sent out isn't going to be paid in time for Jimmy's piano lessons or whatever it is. And there's a lot of things out there that are out there working against you, trying to appear like they're helping you. So if you need a third party opinion, that's exactly why we're here.
Awesome. Ryan, how about you? Anything to add? Or are we shutting it down?
Oh, just remember, if the iPad is free, it just means that they're playing hide and seek with the fees on you. So make sure you do your research, and they're very well trained fees for that matter.
Yeah, for sure. Nothing's really free in life, right?
Yeah.
Nothing's really
Death and
free.
taxes. Oh no, that's nothing certain. Yeah.
Yeah.
Death and taxes are free too. Well, you have to pay
Yeah.
tax. Death is free.
Well, guys, it was a good episode. If you are watching, listening, we are going to be sending this out in podcast format as well as a YouTube video format, and ultimately also a blog post. You can also find us at our various social media accounts, our YouTube account, Facebook, Instagram, LinkedIn, TikTok, and also finally you can find us at our website, tvhfinancial.ca. Give us a call, 647-727-4668, or email us at financial@tvhgroup.ca. Thanks, guys. Another wonderful session. Until the next time, take care.